order to get a mortgage for a residential property in Canada, you have to qualify with your personal income. So let's set the stage. What's a residential property? What's considered a residential property is a property with 1, 2, 3, or 4 units that is zoned residential. And in very few cases, some lenders would consider a 5 units property or a 6 units property a residential as well, but that's not the majority of the lenders. But anytime you apply for a mortgage for any of these properties, be it your residence or your second home, or a recreational property like your cottage or a rental property, you have to qualify with your personal income, regardless of whether you're holding it under your personal name or you're holding it in a corporation. Yes, even if you hold it in a corporation, you have to qualify with your personal income. So in this video, I want to share with you what the lenders look for and give you some tips on how to plan your income. There are several categories of income that we're going to talk about. The first category is an employee. The second category is self-employed. The third category is if you're retired. And the fourth category is other income that you may be earning. So if you're an employee and you've got your pay stubs, you've got bonuses from time to time, that's really pretty straightforward. The lenders are looking for a proof that you're getting paid. Sometimes they want to see the stubs being deposited into your bank account, and not every lender requires a letter of employment. So by speaking with your mortgage advisor, they can let you know if the lender is going to require a letter of employment or not. Not every lender does. If you're employed with seasonal income, where you're working during certain times of the year, but not the entire year, but you do have subsidy through a union, we can work with that income. If you have fluctuating hours, right, the lenders would want to see 2 years of that income in order to work with a number that they would consider stable, okay? But regardless of your income situation, there is a way to get the deal done. It may not be with a bank initially, it may be with an alternative lender or with a credit union, but the best thing you can do is to sit down with a mortgage advisor and to discuss not just how much you make, but how do you earn your income, and let them review ahead of time the documentation needed to support that income. You don't want to just fill in a mortgage application and say that you make $100,000. You want to obviously say what you make, but you want to show ahead of time the documents to support what you're making. And that is a very key point for planning purposes. If you're a self-employed client, I've got some good news for you, because here's the thing with self-employment income. Let's say you are a sole proprietorship, or you may have a corporation and you pay your stock from the corporation. If you're looking to get a mortgage from a bank, well, what will the banks do? The banks would want to see that you have paid yourself enough money from your business for a period of 2 years to qualify for the mortgage. They want to see that. And they also want to make sure that you don't owe any taxes to Revenue Canada. Some of the banks or some of the lenders on the street have special programs where they will take some income from your corporation and add it to your personal income. And that's a beautiful program because that allows you to qualify for a bigger loan. Now, that's what the banks do. The alternative lenders have more flexibility when it comes to income if you're self-employed. They basically have programs where they would look into your deposits into your business account, and they would want to know what your expenses look like, and that's what they would go by. It's called the Stated Income Program. And under that program, they're not looking for your tax returns, they're not looking for the 2 years, so that gives you options. And some of the credit unions also have programs like that. Now, here's an important thing to do if you're a self-employed client. If you're looking to purchase 1 property, 2 properties, 3 properties, it does not matter. You want to plan your income. You want to engage your mortgage broker in a conversation with your accountant and yourself. Why? Because let's say you want to buy 2 properties this year. And your mortgage broker says you're going to need to show that you've paid yourself from your business this much income in order to qualify with a bank. Now, what you want to do is you want to bring in your accountant and have this conversation about how can you pay yourself from the business this amount of money and what will the tax implications be. That's one path to get mortgages with the banks. But maybe the conversation is, you know what? I am not going to pay myself this much on the personal side. I'm just going to keep my money in the business. And I would like to discuss what would my financing look like if that's the case. But at least you're going into the year with a good understanding of the pros and cons. How are you going to show your income? Are you going to get a bank mortgage? Are you going to get an alternative mortgage? You don't want to go and file your taxes and then take that after you file and have that conversation, because when that happens, your mortgage broker or lender will just have to figure out if the deal fits or not. But when you are in the driver's seat, you can control how much you're going to pay yourself, how are you going to pay yourself, and that opens up possibilities for you. This is super, super important for self-employed clients. If you are retired and you're receiving pension income, the lenders will use that income. If you're receiving income from a RIF, registered accounts, they will use a percentage of it. We just need to see how much of that we can use to help qualify the deal. There are other sources of incomes that the lenders will consider. So you may be getting a child tax credit. Not all lenders would use that, but a good mortgage broker would want to leave no stones unturned for you. You may not remember all of these details, but a good mortgage broker will ask you questions to say, okay, is there anything else you want to tell me about your income? Do you have kids? Are you getting this tax credit? They will leave stones unturned. So if you're receiving a child tax credit, some lenders will use it. If you're receiving investment income, let's say you're investing in a stock portfolio and you're getting dividends, can the lender use that income? Yes, the banks will use that income if you are reporting it on your tax returns for 2 years. Remember, the banks are looking for stability. The alternative lenders and the credit unions will work with this on a case-by-case basis, okay? But again, this is why it's super important to have a conversation ahead of time about the sources of your income and how you're going to report your income with your mortgage broker. This way, you are in the driver's seat and you know exactly what type of mortgage you're going to get when the time comes. You don't want to be reactive with that conversation. But personal income is a huge component of qualifying for a residential mortgage in Canada. And here's an important tip for you. Please keep your down payment boring. What do I mean by that? The less sources of down payment, the cleaner your account, the more organized you are, the boring you make it, the smoother it will go. But the more sources of down payment you add, the more movement of money that goes around your bank accounts. Again, not that there is anything wrong with it, the more complicated your down payment story is going to be, and the more complicated and time consuming your file is going to be. So keep your down payment boring.